All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and continue our 30 Indicators in May series. Yesterday we talked about the, this RSI, Relative Strength Index, developed by Wells Wilder, back published 1978. Very nice indicator. And we mentioned that we'd talk about a few other indicators of his because he did a great job of using indicators to tell a story. And so let's go out and take a look at maybe the simplest of the indicators that he developed and the most simple in terms of its read, in terms of its understanding, in terms of its calculation, but yet one of the more important ones, and one that has some very strong tendencies associated with it. I'm going to come up here to Chart School in stockcharts.com, and I'm just going to come down here to Technical Indicators and Overlays, and I'm going to scroll all the way down here to the ATR, Average True Range, right? And just click on that, and it'll give some information about it. Wells Wilder, talked about it in his 1978 book, New Concepts in Technical Trading Systems. Really interesting book, by the way. If you're really wanting to get into technical analysis and understand some of the roots of it, and how things are kind of laid on top of this base, it's a great book. It's a great book. But here we go. The method is very simple. It's just this kind of true range method where he's looking at highs and lows and closes and, really kind of taking some of the variance out of the calculation and just finding what the average range of the stock is over the course of a certain period of days. That's it. It's really simple, Okay, is this stock moving more now? Is it are its highs and lows a lot further apart than they used to be? Are they closer together than they used to be? That's it. It's a very simple indicator, but has some very profound implications associated here with it, especially for option traders. So let's go out and let's just take a chart here. U.S. Steel reported earnings today, so let's just go take a look using U.S. Steel. And I'm going to come down here to indicators. I'm going to put on the average true range, and we're going to see something here, right? The average true range right now is 70 cents, right? That means you can kind of expect on a daily basis that the difference between the high and the low in the stock is going to be about 70 cents. Okay, right? Okay. That's not crazy for a $15, $16 stock, but, that's a pretty good percentage. You'll notice the ATR is kicking on up here today. Why? Well, the difference between the high and the low today is what, $1.30, $1.40? So it's well above the recent average true range. Now, the tendency for stocks is that when the average true range falls, the stock tends to go higher. And when the average true range rises, the stock tends to go lower. You'll notice with U.S. Steel, that's just not quite the case. Just isn't quite the case, right? One of the reasons is because look at the stock price. It's $40 up here. What's a 1% move at $40? That's basically what? That's 40 cents. A 3% move is $1.20. A 3% move at $40 is not a 3% move at $15. When you have stocks making huge price changes, the way U.S. Steel has made, the ATR is not as valid. It's not as important. It's not as good to show a tendency. But when you have a stock that's staying within a relatively reasonable price range, it's not moving 50% lower and 30% higher, the ATR is one of the best indicators. It's not for penny stocks. It's not for stocks making monster changes like like U.S. Steel. But you go and apply something like this to a Caterpillar, we have some major implications. Take a look at as the ATR is rising here, what's happening. What's the path of least resistance in the stock? The path of least resistance is lower. You'll notice that this move higher right here corresponded to a move higher in the ATR as well. Showing you this because it's tendency, not absolute. We can get very heavy, strong moves to the upside where the average true range expands. But generally, those are followed by sharp, dramatic downturns. And we see that when stocks rise on a rising average true range, we tend to see them fall on a even more rising average true range. But what happens to Caterpillar as the average true range starts to fall? What's the path of least resistance of the stock? Yeah, it's not up every day, but it's moving on higher. And that's the tendency. That's the tendency. Average true range falling or downward trend, stock tends to go higher. Average true range rising, stock tends to go lower. And think about it kind of psychologically here. Investors, traders. When things aren't moving a whole lot, when the average true range, the difference between the high and the low is pretty small, investors are more likely to step in, less likely to pop on out. They're not questioning what's going on. There's not a lot of uncertainty. And when there's not a lot of uncertainty, the path of least resistance tends to be higher. But when you start changing into an environment where there's massive swings in the price of the stock, where, you know what, it opens up at 146 and it closes at 140, and then the next day it opens at 140 or 138 and rallies to 144 and then drops to 136, it leaves everybody going, what's going on? What's happening? And what do investors do when there's uncertainty? When there's a rise in uncertainty, they sell first and they ask questions later. And so when the average true range of the stock gets bigger, investors tend to sell. And that includes on the upside. Here's Caterpillar on the upside. Massive upside. But look at the average true range rise through this. Is this making investors feel all comfy cozy? No, it's not. And investors tend to sell those types of things. And we see them, sell it. But then what do we see? We see the market, we see Caterpillar start going up with the average true range dropping. That's a little more comforting. Investors a little more willing to step in. Yeah, there's an earnings gap. Okay, great. That's an earnings phenomena. That's not a price action phenomena or a technical phenomena. But as it rises, as it goes, we see the average true range fall. And then perhaps one of the most telling things here in March, the average true range is dropping even as the stock is falling. When we see that, generally the next move on the stock is going to be higher. Okay? It's that simple. It's that easy. But think about applying this to options trading. When the average true range is up here, what's the price of options? Price of options is really expensive. When the average true range is down here, what's the price of options? Options are really inexpensive. They're really inexpensive relative to a period of higher volatility or higher average true range. One of the biggest payoffs for option traders is to be able to find a move in a stock, particularly a downside move, where they can set up put options and have the average true range rise while the stock falls. Why? Because put options, you get paid for the stock going your direction, downside, plus you get more volatility added into the option or implied volatility added into the option, which helps to increase that value as well. You get kind of that double dose. When you're playing calls, generally you're playing to the upside, and the implied volatility is going down. So you're actually going to be losing a little bit on your calls day by day on implied volatility. So one of the more profitable scenarios for option traders is to hit on puts when the average true range is just starting to take its next big leg up. And when you catch those waves from an option standpoint, they're not easy to ride because, there's a lot of variance and a lot of swing in the stock price, but they can be extremely profitable. Can you look for this? Can you scan for this? Can you find this? Well, the best way, just take your watch list and start going through it. All right, here's Apple. Where's the average true range? Okay, here we are. All right, average true range has been falling, right? Been falling here as it's risen. It hasn't been falling too much further lately. It got a little bump up here on earnings, right? A little bump up on earnings. But we don't have a major kind of trend shift in the average true range. So not really, can't really expect a rollover right here based on this average true range. Okay, great. Next, go into my next stock and say, all right, what do we see here? Here's Johnson & Johnson, for instance. What do we see? All right, stock's been going up. Average true range has been going down. But average true range has been rising. I mean, you can see this in the variance from day to day, right? The average true range has been rising here. It doesn't mean go out and short it right here, but tells me if I do get a bear signal, hey, go take advantage of it. Because the chances are that the sell is going to be pretty intense. Let's go to Pepsi. Sitting near new highs, right? Sitting here right up near new highs. Look at the average true range over time has been falling. It had this little uptick around earnings. Great. And we see the average true range starting to decline again. But if we start to see the average true range start to tick back up and the stock break down, there's the opportunity to short it. Is it there yet? No, it's not. And when you look at a lot of stocks out there, they look like J&J. They look like Pepsi. They've had a little bump in average true range because of earnings, but the trend on average true range really hasn't shifted here just yet. But if we start to see the average true range rise, that's a pretty good sign that these stocks are ready to drop and ready to drop in a big way. Obviously, not there yet. Take a look at something like a Home Depot. Right? Here we go. Home Depot is sold off. But look at the average true range. Are we talking about a trend shift in the average true range? No, we're not. We're not talking about something where the average true range has higher highs or higher lows, or even something like right back here when Home Depot kind of blew off the top, right? Notice how it's rising, average true range on the rise. Generally, that leads to a sell-off. We have average true range actually pretty flat here while the stock's selling off. What does that suggest? That suggests this is just a minor little correction, not a new big bad bear trend starting to emerge here with Home Depot. Could that change? Yeah. And if we start to see the average true range start to bump back up above about 320, 330 here on Home Depot, yeah, we could be talking about path of least resistance significantly to the downside. You'll notice I'm not using average true range as some sort of entry trigger or exit trigger. What is the story, right? Well, the story is path of least resistance. And when average true range is rising, path of least resistance is lower. When average true range is falling, path of least resistance is higher. And when we see divergence, meaning when we see a stock going up on a rising average true range, generally there's a sell-off to come. If we see a stock selling off, but average true range is still falling, generally there's another rally to come. That's it. It's that simple. It's that basic. And it tells us a heck of a whole lot. It really, especially from an option trader standpoint, it speaks volumes. Take a look at something like Wynn Resorts, right? Here's the average true range. As the stock has gone higher, it was actually higher, isn't it? This is something I'm watching. It's not something I'm short yet, or even have anything close to saying, well, I want to get shorted. But we start to see the stock break down. We now have an average true range that has been rising as the stock has been rising. A lot of times these are followed by further selling. When we have the stock rally while the average true range is declining, yeah, we'll get small corrections, but generally it's still going to be in the bull's hands. That's the ATR. It's pretty simple. It's pretty basic. It's pretty awesome. One of my favorite indicators. Now, I don't do this, but you will find literature and books and traders that take an average true range and bump up the time period here. They'll go something like 30 days. Okay? And when you bump up the time period, you just get a little bit of a different look. In fact, let me kind of compare these so you can see it. But average true range, 14 and 30. 30 is on top, 14 is on bottom. You see a little bit of difference, but it's not tremendous. The 30 days is just going to be slightly smoother. That's about it. Okay, but they'll come in and they'll take something like a longer term one, like a 30-day, and they'll come in and they'll add an overlay, like a simple moving average. So they'll take something and add a 20-day moving average to the indicator. Our blue line is the 20-day moving average. And they'll say something like this. Okay, when the average true range moves above its 20-day moving average, you short the stock. When the average true range moves below its 20-day moving average, you buy the stock. So right here, you'd be a buyer here in January, right? Right here in October, you'd be a seller. You'd be a buyer right here mid-September, a seller right here early September. You don't have to go through many stocks for very long to know this just doesn't work all that well. It does in hindsight to see some of the really big trends, but it's not a great entry trigger. It's not something where you can set up some sort of algorithm or automated trading to look at this and say, oh, okay, just do X when it does this. But you'll see this type of thing out there in the market where they will add a moving average to the average true range. But most of the time, and I've played with all sorts of moving averages with it, just most of the time, it just doesn't mean a heck of a whole lot. I mean, you take a look at Caterpillar here, and you can see it's still below, its average, and that's one way to kind of tell that, hey, you know what, we're not talking about a significant move in the ATR, right? Yeah, the ATR might be moving up or flat, but we're not talking about a significant move in it yet. If it starts to move above the 20-day moving average of the ATR, maybe we are talking about something a little more significant, as you can read a little bit more into it. But it's not something I add to my charts or I use, because I can get that story without it. But, if you're just trying to kind of look at the story a little bit more, really kind of understand the story a little bit better, you can add that, and it does give a little bit of a better read when it comes to the story of the ATR here. Okay. So anyway, that's the ATR. We'll be using it a lot as we go forward, especially as we start to stack indicators on top of each other. But go out, play with it. Pop it on your charts every once in a while. It's a great indicator to look at, like on the weekends, if you're going through your charts over the weekend, to look at them when the market's, calm or off, and wanting to see, what kind of major shifts are starting to happen. It's a great indicator to have on your charts. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.